we talked about analyzing the operator, and today we get to go into the nuts and bolts of analyzing a deal. In this one, I get to take a step back. Gabe, this is your specialty, and I can't wait to kind of learn from you in this process. I know you've spent how many deals do you think you've analyzed, multifamily deals you think you've analyzed in the last 12 months?
Last month? Yeah, I mean, usually I try to do 10 to 12 deals a month. We have a pretty steady flow of deals. Again, sometimes it's as easy as looking at a short email and understanding that I'm not interested in the neighborhood after doing some analysis on the neighborhood. And we'll talk about some of the steps that we take in analyzing deals. But for the most part, I think this all comes down to analyzing a market, being able to better understand the pro forma, which is like a spreadsheet version of the business plan, like how things are play out over time, and then using some sensitivity analysis to say, okay, what's my best case, what's my worst case scenario, and if you can do those three things, you oftentimes have a pretty good shot at picking a good deal.
And then, is there a difference when how you analyze a deal from an operator standpoint versus an investor standpoint?
Some operators simply love a certain portion of town, right, in a given market. They may love that portion of town because they live near it and it's easy and convenient, or they have other assets near it. That doesn't necessarily mean that it's a healthy addition to your portfolio as an investor. So you have to really better understand, what are you looking for in an investor, in an investment, And some of the things that I've kind of broken it down into in terms of being a passive investor is very similar to being a stock investor. Some people want total return, right? When you're young, when you're just getting into this world where you can afford to put 40, 50, 100, 200, 300K at a time on a real estate deal, well, you may be in a situation where you're trying to get the maximized return profile. So whatever the biggest number you can get back in the shortest amount of time. And oftentimes those kinds of deals will take on certain levels of risk. It doesn't necessarily mean it's higher risk or lower risk than a different type of deal, but it is ultimately one of the things you're looking for is total return. I've seen a lot of other types of deals where you're really looking for cash flow out the gate. And that can just decide what kind of asset you get into in multifamily. You can also decide whether or not multifamily is the right fit for you. Multifamily has its waves. Sometimes it's very cash flow heavy. I'd say right now, because it's so popular and because office and some other commercial real estate types are doing so poorly, I'd say right now it's actually kind of a slower opportunity for cash flow. So if you're looking to sort of see cash flow in every month, well, you're going to want to find the deals that have the maximum amount of distributions. So more stable, steady Eddie coming in at a good price point where they're borrowing at a lot less than they're producing in terms of cash flow. And those deals, have been few and far between for the multifamily space, but you can find them in other asset classes or other sort of instruments and investments similar to this. Another thing you may be looking for is extremely low risk. So you're trying to minimize your downside risk. You want it to grow. You want to be diversified from your stock portfolio, but you ultimately don't want to run into any big headaches where the operator is hitting you up saying that they need to invest more money or that you're going to have a total loss on your investment. So, when you're really trying to play the safe route, you're usually going to have a less exciting upside, and you're going to have less opportunity for maximizing your return. But, really, you want to look at this and see from an investor standpoint, what kind of investment are you going to get into? And as we've talked about, that's going to help you decide what kind of sponsors are you going to look into. We talked a lot about what you need in a good sponsor and how to kind of pick the jockey instead of the horse. For today, I wanted to start off and talking about really those three things that I mentioned, which is stepping into analysis of a market before you even start to pick out deals. And, I think there's a ton of ways you can analyze a market. I'm going to shovel pass it over to Misha briefly just to hear what he thinks about, and then I'll plug in anything that he doesn't cover. But sort of, Misha, what do you typically look for when you're analyzing a market?
I'm looking for stable job growth where in general people are moving into those cities versus leaving it. And then people are moving in, they have more money, hopefully, than what's going out. I'm looking for just kind of your basic supply and demand. Is there way more demand than there is supply in those areas? Is there proof, or is there not a lot of new supply that's going to be coming, so that that I know I'm going to be able to get high rental prices, and then looking for a strong economy wherever I want to invest in.
I love each of those pieces. I want to dig into those just in a little more detail because I think they're each in of their own. It'd be impossible for us to spend only 30 minutes and cover off on sort of exactly how to analyze a market. Misha and I are both available if you guys want to go ahead and hit the link in the description and set up a time to chat with us in more detail if you're looking into investing in this space and some markets you want to take a closer look at. But I'm going to start at the top of what Misha mentioned. So he talked about looking at markets that are growing. And I want to be really specific there. You want markets that aren't just growing in population. Oftentimes, I've seen markets that are growing in population flip-flop very quickly from being a great market to a poor market because they don't have some of the fundamentals that you want that will always draw people to a market. One of the things that always draws people to a market is solid jobs, especially if those jobs are diverse. Meaning they've got a diverse core, well-educated population. They don't just depend on oil and gas or technology. They've got a great mixture of all of those. And so when I've started to look at markets like Tampa, like Dallas, like Nashville, what's amazing about those markets is they've got a growing population, but they've also got a really strong job base. One way you can really cheat code and kind of get a sense of whether or not a market is growing or not is by picking on, we'll call it LA and New York. And, right now, those aren't particularly well growth markets. They're not growing very quickly, either of the two. They used to, and now they've sort of maximized. And a lot of these other Sunbelt markets are what are growing. What you can do is instead of like using all the fancy tools and tricks of the trade like Misha and I have access to from a data perspective, you can do something as simple as pulling up uhaul.com. So I'll share my screen real briefly just to kind of poke in there to show you what I mean. If you wanted to take a look at whether or not you've got a growing market or a decreasing market, I like to pick on New York and San Francisco and LA, but we'll just use New York in this example. You could take a look at the cost of a U-Haul from New York to your location and then do the reverse from your location to New York. And if the number is significantly cheaper to go from your location to New York, what that tells you is there's a lot less people going from your location to a big city like New York or a big city like San Francisco or LA, and a lot more people moving from that location to your location. So I've always used that as kind of a trick of the trade to see what is actually happening in my local market. Now, where I live, which is really close to Dallas, Texas, is in a place called Collin County. The zip code is 75094. So let's just take a look at what would happen if I went from New York to my location. How much is a 10-footer going to cost? And the price is going to be $2,400. All right. So I'm not sure exactly how this will work, but let's just take a look. My hunch is that because I know Plano, Texas is an extremely fast growing community and one of the best parts of the country to invest in, my assumption is it's at least going to be 10 or 20% cheaper to go from Plano to New York than New York to Plano because more people are moving from New York to Plano than vice versa. So let's take a look. Remember, 2,400 is our number. And then let's reverse those. So let me back out Plano here, put Plano up top, and then put New York, and see how much easier it is to get from Plano to New York. Oh, wait, that's about $600 cheaper. So yeah, it's actually closer to 30% cheaper to go from Plano to New York than New York to Plano. And again, this is just a cheat code. I'm going to stop my share. But just one of the ways that I try to take a closer look at, like, is the population truly growing? When you compare to a robust economy like New York City, right, you're going to at least have a good baseline of understanding of whether or not you've got a really good market to invest in. And I bet you if you use Tampa, Nashville, anywhere in the Dallas-Fort Worth area, you're going to see that it's a lot cheaper to go away from that location than to that location on U-Haul. And that's just an example of the population and job growth. So again, population and job growth is something you want to find in your market. And another thing you want to find in your market is you want it to be landlord and business friendly. Now, this isn't a political statement, but that tends to be the case in red states, so to speak. And in blue states, it tends to be a little tougher to find landlord and business-friendly communities, but that does not mean it's an impossibility. If you take a look at California, you would find that a city like Bakersfield and a city like Chico and any of the cities running up and down Highway 5 are a lot easier to do business in than some of those coastal cities where you may have some of the headaches related to local politics. They're going to be anti-business friendly, anti-landlord friendly, very renter friendly. And so I think that's one of those things that in this business in particular, multifamily, you've got to stay focused on. Push for a landlord and business friendly investment and you will get better returns net. And then, the last thing that me and Misha have put on our sort of market analysis at a high level is within a market, there are submarkets. There are little pockets that you want to invest in. There's good pockets and bad pockets. And we have found our niche in finding better pockets by finding median incomes that are well above the median average. So a median income is what you're going to want to use. You don't want to use average income. I won't get into the details of the reasons why, but just note that averages can be thrown off by a billionaire that lives in your neighborhood. So you want to be really careful about that and use the median income. Typically, when you're in an apartment complex, people are going to rent from 1 mile around you. So you want to use the 1 mile median income to try to figure out whether you've got a strong median income or a terrible median income. And these are working class communities. So we don't expect it to be in the top 10 percentile. I don't want to rent or buy in those areas. I'd like to buy in the areas where it's a little bit above average. And so in Dallas-Fort Worth, we found a sweet spot. 55 to 60K median income is about our cutoff, depending on the asset and the age of the asset and opportunity. We'll sort of play in anything where the median income is at least 55 to 60K. And then the other thing you can always note is by looking at niche.org or Better Schools or greatschools.org, you can find the school ratings. And we really like to stick to schools that are B+ or above on niche.com. For market analysis, that's a quick and dirty. And I hope that 5-minute overview of how we look at markets helps. Really looking for not only a great market, but a great submarket within there. And then the last tip or trick I'll tell you about a submarket is Starbucks and Chick-fil-A. Those are two, sort of retail shops, retail businesses that spend a lot of time and money thinking about where they place stores. So if you've got a Starbucks, not the kind that's inside of a Target or a Walmart or whatever, but a Starbucks that's a standalone Starbucks, you're often going to find that about 1.5 miles around that is a path of progress, a place that's growing quickly, a place that has strong demand and solid fundamentals for investing. Same thing with Chick-fil-A. It's a little tighter window around a Chick-fil-A, but typically about 3/4 of a mile to a mile around a Chick-fil-A, you're going to have a pretty solid economic base to work from. You're going to have some solid potential for investments. So we call that like the Starbucks factor or the Chick-fil-A factor. We love to look at assets that are right down the street from those. And just like the asset we recently purchased in February, we bought one right down the street from both, actually. So again, those are some cheat codes for finding good markets. But we're talking about deal analysis, and it goes a lot further than just finding a good market or a good neighborhood. I think you can actually make a lot of money in bad neighborhoods if you know how to analyze a deal. So, there's a whole set of people that specialize in walking through deal analysis, and it's cumbersome. It's one of those activities you're going to want to spend a few hours learning more about. For the sake of this conversation, I will just say that every good sponsor, remember that was the first step, pick a good sponsor, should have a strong and defensible set of underwriting that they're not afraid to share with you. So an example of analysis on a deal we just took down in February. This is the Bedford ULIS portfolio that we took down that we're renaming. And every pro forma is going to have the unit mix, the asking price, sort of the lending criteria, how we're setting up the debt, what the closing costs are, and some semblance of an understanding of the returns as you go through that analysis. A really important thing to better understand on any deal you're looking at is, how aggressive are they being about the rents? Are they trying to say rents are going to go up 50%? Or are they trying to say rents are only going to go up 2 to 3 to 4 to 5%? And I think the less aggressive people are on the rents, especially in this market, where you can find perfectly good deals that you don't even have to push the rents up a bunch on, then, if you do end up pushing the rents way beyond 3, 4, 5%, the deal still works. The point is that on a deal where you have to raise the rents 20 to 30%, you are putting yourself in a position where you won't be able to reach your pro forma unless things go really, really well. And it's much better to sort of start off with a deal that has a much more conservative approach to rents. Now, the other thing that you want to look at in addition to your thinking around rents is, does the person who's underwriting the deal spend enough time getting to know what the real expenses are? So on our deals, we always create a 5-year business plan model, right, to give some people an understanding of what's going on. And within that, we have expenses, and every single expense, everything down to the trash expense and the pest expense, is validated by a third party. That way, it's not an emotional attachment to where we think something can get to. And that's what every good sponsor should have in their local market. They should know how to define the contract services like landscaping and waste removal, because they should know the companies that provide those services well enough to get a quote prior to taking over an asset. They should know exactly how utilities are going to play out. Utilities are a really huge expense, and every market should have a specialist within that market. In our market, we use Energy Serve, which is a company that buys electricity in bulk and can help you define whether or not you're high or low on your predictions around water usage. And those are really water and gas. And so those are really the big three when it comes to utilities, although there are a few others. Your repairs and maintenance should come from experience. If you're working with a group that doesn't know what the repairs and maintenance should be in the neighborhood because they haven't done enough deals, you should probably look at working with a more experienced group. Payroll is really critical and can be validated by a third party like a property management company that does that for a living. Thankfully, Misha, my business partner, runs the regional area that we serve in Dallas here for his property management company. And so he knows these numbers to a T. And it's very, very helpful working with him because, as you can see, an example like this, we were able to dial it in, not just at a high level, but down to the dollar on what we would expect to do. Again, an experienced group should understand their vision for marketing expenses. And then the big two, the uncontrollables, you should have a specialist in your back pocket for those. So insurance and property taxes. Property taxes here in Texas are very, very, very quirky. They change county to county. So we work with a company called CMI here in Texas. And that company helps us identify everything we need to know about property taxes and where they're going to go, not just the first year we take over, but 3 years into the future. And for insurance, a really good insurance provider, an insurance underwriter, they should be able to help you define what your pro forma is going to look like. And so you just get an indication from one of those people, and then they can help you steer your ship in terms of expenses. And so you take your property data, your rent pro forma, and your expenses, and then you're going to model that into what we call a pro forma deal analysis. And one of the things I see people getting tripped up on is whatever deal analyzer you're using or spreadsheet you're using. If you guys reach out to me and Misha, again, we're happy to share some of the templates that we have access to. Can't share this one, but I have a few others that I've been given permission that I can share out to people. And what I find is that a lot of people don't quite understand this bottom little indicator here called the reversion cap rate. This is a way that I've seen really shady operators sort of trick people into thinking they have a great deal when they don't. There are reasons for putting that number high or low. The higher you put that number, the more conservative you're being about your sale price. And as you change this number, it's going to change what your sale price is going to be when you project out into the future. If you keep this number really, really low and you are not conservative, then you run the risk that the market has changed over 3 to 5 years when you go to sell the asset. And one of the things you should be looking at as a passive investor is getting a really clear definition from your sponsors on why they've chosen a particular reversion sort of sale price or cap rate. And reversion just means the one that they're picking for when you go to sell the asset at the end of the deal. That was a lightning speed move down analyzing deals, and just wanted to give you guys some of the verbs and nouns and adjectives you should be looking to better understand as you get into this business. But once you get a basic set of like 20 concepts down, boom, 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 you can analyze deals pretty quickly. It doesn't take a whole lot. And I think a lot of times people think about it maybe too much. So that's why me and Misha chose in this series to start with, pick a really good sponsor, a sponsor with a track record of delivering on their promises and sort of hitting their mark in terms of their pro forma numbers. That's going to be extremely helpful for you as you get into your deal analysis, because then you're going to have a lot of comfort where, hey, maybe you don't know what the heck Gabe was talking about with the reversion cap. And maybe the numbers look really good, but you're not exactly sure how to pick them apart in detail because you don't have access to a Texas-based, tax specialist. And the sponsor says they do. Well, I think if you've got a really good sponsor and they have done their homework, you can trust their numbers and you can trust their analysis a lot more. So I think this is just an idea of, hey, let's give you guys a little bit of food for thought and a couple areas that you can start to begin to master for particular markets you're interested in once you pick a good market. And that'll allow you to do a better job of, having 7 to 8 really good questions to ask every sponsor and pushing them. Now, if you want a list of 50, Misha and I have prepared one of those for you. So we're going to put a link to the 50 questions that we think you should ask every sponsor before you go ahead and invest in their deal. You can't sit down and ask them 50 questions. We put a list of 50 together so you can choose maybe 7 to 10 from that list. So if you had a half-hour conversation with your sponsor, you could go through your top 7 to 10. But we wanted to give an exhaustive list because a lot of times many of those questions are sort of checked off of the checklist in the webinar presentation. Do a little more digging into the offering. You'll probably check a few more questions off. Dig into the private placement memorandum or the legal documents and paperwork associated with a deal that you kind of like that you're thinking about signing up for. Maybe check a few more boxes off. And then grab 30 minutes with your sponsor before you make a final decision and say, hey, I've got these 7 to 10 additional questions I want to ask you. Misha, any thoughts on those first 2 areas of analyzing a market and then reviewing specifics on a pro forma?
I have any thoughts on there? I think my question for you is, so as you mentioned, you probably analyze 12 deals a month, right? Mm-hmm. How long do you think it took you to feel comfortable with that process? Was it?
Well, I knew I wasn't comfortable when I first started looking at deals and I was sort of out there on my own trying to teach myself how to do it. A lot of YouTube University. I think this business it's important to have people with some experience that you can reach out to and get advice before you put your money in many things. Again, I'm trying to be that. I mean, that's the whole point of this series, right, Misha? Is we're trying to be that for other people because we had that when we got into the business. For about 2 years, I was really uncomfortable with this. For about 2 years, I think I was putting my money at risk by considering deals, especially these deals I was looking at in the Midwest, without truly understanding how to pick even a good market or a good sponsor. And I was fortunate enough to join a mentorship group, and from that, I had these coaches that sort of required that I look at it with them before I make any investments. And I did that on every deal that I was interested in until I got good. And so now I can sort of fly on my own as long as I'm using the right sort of analyzing tools, ones that I'm familiar with, ones that I've used a lot. And it takes me, 5 minutes to decide whether I want to underwrite something just by reading through the offering, and another 25 minutes to do all of the analysis that I need to consider it does this make it to my next stage or next step in analysis? If it makes it to the next stage or next step, then there's 2 things I need to do. I need to get third-party data. So I have to call my friends at the tax indication company and my friends at the insurance company and my teammates, my acquisitions analyst, who's going to dig a little deeper, figure out what trash is going to cost, what landscaping is going to cost, and start to really understand the asset. And then over time, when I'm doing analysis on a deal that we're actually going to purchase, I'm going to spend hours. Right? I disagree with even my mentor who says you don't really have to do that much analysis. I disagree. I think you're going to spend a lot of time refining your business plan once you've made a decision to purchase, or at least to go through diligence. But if you're just looking at this from a passive investor standpoint, you really only have to hit that first maybe hour of analysis, right? 5 minutes to decide if it's something you want to deep dive into, 30 minutes to decide if it's passing your bar of what the pro forma analysis might look like in comparison to what the offering is telling you is there, and then another 30 minutes of conversating with somebody, maybe two people that are in your back pocket, and giving them 15 minutes each to kind of look at the deal with you. And after about an hour, you can decide whether or not you've got something solid or not. That's typically what I find. Now you can spend more energy. You can fly into the city and see an asset. Another thing you can do if you've never invested with a particular sponsor, and you've never done any of these kinds of investments before, SEC attorneys will review the deal with you. It usually costs a few $100, but it's an opportunity for you to really learn if there's any gotchas in the legal paperwork on an investment. And that's really all that I would recommend for passive investors. For me, to answer your question more concisely, it took me about a year to get very comfortable underwriting deals consistently. And then it's like a muscle. It's not like riding a bicycle. It's like a muscle that you've got to work out a lot, especially in one particular market.